This is Alan Bush with ADMIS with the daily financial forecast for Thursday, February 18th. Starting out with the stock index futures, first of all, I just came up from the trading floor, and what people are talking about there is what the Fed had said in the release of their minutes from the January FOMC meeting. And in those minutes contain generally dovish, on balance statements. This suggests that the Fed may not be in a position to raise interest rates anytime soon. Also, we did have stock index futures being supported not just because of the unbalanced dovish statement, but also due to energy prices that have been strengthening lately, especially crude oil, which is higher again today. Longer term, though, we do feel that stock indices will be supported by the globally low interest rate environment. Now, moving over to the currencies, the dollar index advancing. Feeling is that the Fed, even though they are a bit less hawkish than they had been for quite some time, the Fed is still the most hawkish of all of the major central banks, followed by the Bank of England, which is a very distant second. So the dollar likely to be well supported this year due to interest rate differentials that remain favorable to the greenback. Some pressure developing in the yen as a more stable international financial market situation, causing flight to quality longs to be liquidated in the yen. Also seeing some pressure in the Australian dollar. This after employment numbers in Australia unexpectedly increasing to 6%. The guess was for a rate of 5.8%. This also suggesting that the Reserve Bank of Australia later this year may be lowering interest rates again, and that would be bearish for the Australian dollar from an interest rate differential point of view. Now, moving over to the interest rate futures markets, prices were basically steady in the morning hours. This due to the bullish impact of the Fed's statement yesterday, or at least the minutes from the meeting that took place last January. That being a bullish influence. On the bearish side, we did have higher crude oil prices being a negative, so those somewhat evenly balanced. However, more recently now, starting to see interest rate markets trading higher as stock index futures coming off of their highs. Overall, it looks like the credit markets will be fairly well supported by an interest rate environment globally that remains very low, and also on prospects of central banks around the world, especially the ECB, the Bank of Japan, and the People's Bank of China, adding more stimulus later this year. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.